Hello, class, and welcome to our 14th lecture series of Financial Accounting or Principles of Accounting. And I am your instructor, Dr. Jamal. Okay, so in our previous lecture, we covered the accounting treatment of current liabilities. We talked about accounts payable, we talked about the payroll accounts, right? Like salaries payable, wages payable. We talked about the short-term notes payable, all right? So, and now let's talk about the treatment of long-term liabilities. So, our first learning objective would be the account for bonds payable, notes payable, and interest expenses. So, in overall, we are talking about notes payable in long run and bonds payable. Of course, bond payable is more than 1 year financial instrument. So let's just talk about that. So a bond is a debt of an issuing company. So a bond are issued as certificates over which they have company name, they have the principal. For example, one bond is equal to $1,000. We call this face value, maturity value, or par value. Because whenever this certificate is going to be returned, you will be given back 1,000. So that is the maturity value. That is also the face value, what is printed on the face of this instrument, and also called the par value. All right. So we have maturity date printed over here. We have interest rate, for example, 10%, and we have interest payment dates, 10% semi-annually, beginning from 1st of June or 1st of July, right? So the rate that is printed on the debt instrument, which is bond, is called coupon rate. All right. So up till now, what we have discussed, that bond is a liability that is issued, same like shares, but shares don't have the maturity value. The bonds have maturity value. All right. So my question is, why company issues bonds? The answer to that question is, there are two ways to get financing. If company needs finance, or in case of money, so they have two sources. Either you get money from owners, or either you get money from, it should be like insiders, which is called owners, or outsiders, which are called debt providers. And debt providers are banks and can also be general public as well. But if you have gathered, or you can say that, many loans from the bank, and if you want new loan, money, and if you want new loan, the bank refuses to give you loan, then you go to the public. Or what if bank is charging you higher interest rate, for example 19%, and what if you issue loans and you give to the public the coupon of 12% and people are happy, right? Because banks, how the bank operates, bank takes money from the savers and lend it to the companies. So for example, bank promised to pay the savers 10% and give the companies 20%. All right, and 10% they keep it for their profit spread. This is not profit because rent is going to be less, utility bills is going to be less, so we call this spread, right? So in this case, the general public is happy. Why? Because if they save their money with the bank, they will get 10%. But if they buy company's debt, bonds, they will get 12%. So in this case, company can minimize their interest cost as well. But remember, issuing debt, securities or bond is not an easy job. There's a legal process for that. You need to have underwriter and all those stuff. So we'll talk about, I think, in our coming slides. So there are different types of bonds. We have term bonds, we have serial bonds, we have secured bonds, we have unsecured bonds. Term bonds in which there is, for example, terms included, okay, you are going to pay the interest and principals, and there are different terms. Okay, the bond can be treated as inflation protection bonds and all those stuff. So term means in which the terms, the payment structure is already given. For example, okay, we are going to give them interest plus some principles, right? Or the interest payments are going to be like on quarterly basis or semi-annually basis. Secured bonds, so which are, as name implies, secured, so which has some collateral behind. So why I buy a company's bond? Because company said, okay, this is this building that they kept as a collateral, and which means the bonds are backed by some physical assets. If company is not able to pay us, then the bondholders are legally entitlement for the sale of this building and receive their money. All right. Serial bonds, which have series of payments. Normally, they are paid in a series of interest plus principal, like some kind of like installments, because in installment, principal included. Unsecured bonds, the opposite of secured one, in which they have no collateral offered. They just give you, okay, the bond, and the company says that, okay, the money is going to be used for company projects, but which kind of product? Nothing is included. Maybe this money is going to be paid for any kind of purposes, and also not backed by any physical assets. All right. So generally, unsecured debt, because it has a higher risk, its coupon rate is also higher. So what are the bond prices? Bond prices are quoted as a percentage of maturity value. When we talk about the percentage of maturity value, so 100% means that 100% means, or 100 means the value is issued at face value. Or you can say that if the quoted price is 100, which means whatever printed on the bond value, whether it is 1,000 or 10,000 or 1 million, whatever is printed on the face value, that is the price of the bond. All right. So how, okay, we'll talk about it in our coming slide. I think it would be early if I tell you. So just gonna try to try to digest the concept of par value. So when quoted price is 100, it means whatever is the face value or maturity value of the bond is selling at the time at 100, means bond is selling at its face value. So if the price is 1,000, you want to purchase a bond, it will be sold to you as $1,000. We call this bond is selling at par, PAR, par. Okay. What if it is quoted at 1015, 101.5? It means bond it's selling at, so this is basically a multiple. You just multiply it with 1,000. So percentage answer going to be 1.015. So it means on the face of the bond value, it is written 1,000, but it is selling in the market $1,015. So bond price is greater than its printed value, face value, or maturity value. So we say that bond is right now selling at premium. All right. What if the bond value is less than the 100, 88.375, which means you just multiply it with percentage. Answer is bond is selling less than its face value. We call this bond is selling at discount. So up till now, just understand that if bond is selling equal to its face value, it is called bond is selling at par. What if bond it is selling greater than its par value or greater than its face value? We call this bond is selling at premium. And what if bond is selling less than the face value? We call that bond is selling at discount. All right, everyone. Mirko, Marco,
Yeah.
Dave, understand? 10, Miria,
Yeah.
Saik, understand?
Yeah.
Okay, good. Now, the logical question that should raise in your mind is that no matter what is the price, at the end of the maturity, I would be receiving 1,000. So why I am paying right now the higher value or why I am paying right now the lower value? All right. So let's talk about that. So bonds, premium and discounts. At par, we understand that concept. But at discount and premium, what do we mean? Let's talk about this. So whenever bonds are issued